Good morning, everyone. Thank you for joining us for our webinar today, discussing the care fee cap and care fee funding. Just a little bit of housekeeping for you before we do the introductions. Your cameras and microphones won't work due to the Zoom setup, so save your questions until the end, just in case they're answered throughout the webinar. And then if you still have unanswered questions, you can use the chat box or raise your hand, and we can unmute you and you can join the conversation. So my name is Lisa and I work for Athena Care Homes. I'm joined today by Nicky from Eldercare Group. She's going to be running the webinar for us and delivering some very interesting content. So Nicky, over to you.
Thank you very, very much, Lisa. I'm just going to do the magical IT share, and hopefully that is visible to everybody. So yeah, good morning, thank you for joining. As Lisa said, the questions, if you can keep those to the end, just because, mainly because I can't see the chat box as I now go through these slides, so I'm not ignoring you. If there's any hand raising questions, I can't see them until the end. It will be about 45 minutes or so. Don't worry about taking notes because this is being recorded, and I'll get the link sent across to Lisa today, and you can then share that with other family members or re-watch some of the bits that may not sink in first off. There's a lot of content, so I will have to go through things fairly speedily, but that's the benefit of the recording. You can just watch back. Some of the slides, more than others, have got some numbers and content that you may want to re-watch. I also appreciate this is a very general presentation, and you all have specific situations. So it may well be that your individual questions don't get answered. You can pick that up with us separately. I'll make sure you have our contact details at the end. So just to make sure you are on the correct event and you're not hoping to see a cookery demonstration or anything like that, it is a money conversation, and it's about our very confusing system. Some of you may not have entered this system before, some may have navigated it and at the other end, some are somewhere in between. So certainly when my family had to deal with this situation, that signpost is quite representative of how we felt. So the planned agenda is to look at how the system works right now, focusing on care homes rather than care at home, but some of it is still relevant actually for both. Look and understand how it works now, because if we're not all clear how it works now, it's going to be tricky to explain what the changes are that are looming for next year. We will spend just a couple of minutes really looking at the family home and issues around whether that has to be sold, whether it's mandatory that you have to sell your house to pay for care, or are there alternatives? And then in closing, we'll really just have a look at whether there's a way that families, if they are worried about money running out as self-funders, if there's ways, legal of course, to prevent that situation happening. So that's the plan. Just to give you a little bit more background before I start talking, just so you can see where we sort of sit as a company. We are a firm of IFAs, independent financial advisors, but we are really, really specialist. So we've been accredited by the Society of Later Life Advisors, but even within that organisation, there's a mix of types of advice, and many solo advisors are quite holistic with a broad range of skills. We have really only advised on care fees funding and nothing else for the last 20 odd years. So whilst I have the qualifications to talk to you maybe about mortgages or retirement planning, that's not what I do on a daily basis. So I would say my knowledge is quite rusty. The flip is true, that if you talk to an IFA who doesn't talk about care fees funding every day, their knowledge in care funding issues may be slightly lacking. So we are a real true specialist, totally niche. And the company is mine. So it's quite a small company, set up in 2007 in its current format. And as I say, that's because we had a care journey that was fairly bumpy with my grandparents. We got no real advice, and not that I blame anybody for that. It was a classic case of you don't know what you don't know. So we just assumed as self-funders, sell the property, hope the money lasts. It didn't. And then we found out later on there were lots of things that would have been good to know at the time. So this is my experience, really, sharing and choosing to share it with other families so that they don't end up feeling how we did. And whilst we're here at the very kind invitation and organised by Athena, we don't have commercial links with any care provider. Okay, this is not anything going on. We work with many care homes around the UK, and it's just about getting the right information to the people that need it. We are having money conversations, so you would be advised to check that anyone you take advice from is appropriately regulated, and we are directly regulated by the Financial Conduct Authority. And you're probably geographically not too far from me. I'm in Hertfordshire, but actually even pre-pandemic, most of our advice was delivered remotely, phone, email, maybe more latterly, obviously, FaceTime and Zoom. But that's because the family themselves are usually dotted around different parts of the country or even the globe. So making sure that nothing gets lost in translation is important. And if we have emails and call notes, everybody's clear on what was discussed. That's really the reason for it. And our model, our business model, doesn't necessarily mean all companies work this way. Our way of doing things is to offer free advice for part of the journey. So any initial consultation that you have with us, any research of potential financial solutions, all of that's done at our expense, not yours, because we don't want cost to be a barrier to you getting the advice that you probably need. If a financial product is taken out through our company, we're paid a fee, but that's all disclosed, and you'd have to agree to that upfront, so no surprises. So back to the agenda and looking at the current way the system works and how care home funding is set up. I'm going to keep it really simple and say that there are really just three options for who pays for care. It's either the local authority, social services, the council, all the same place. It sometimes is the National Health Service, and if it's not either of those two, then you are a self-funder or a private fee payer. And there can be some overlap, but as I say, just trying to keep it simple. So taking it in turn, the local authority funding stream first. If you think that somebody, a loved one moving into care, needs to move into care, is entitled to local authority funding, and actually even if they're not, everybody is eligible to have their needs assessed. Carers can have their needs assessed by the local authority. So you ask for a social worker from adult social care to carry out an assessment of need. And this is important, this issue of meeting the council's eligibility criteria, because it's the door opener, if you like, for the care cap bit that I'm going to talk about later. So the local authority assess somebody. If they don't think they're poorly enough to need to go into care, then they can say, you don't meet our eligibility criteria, therefore the conversation goes no further. And there was an Age UK survey done, I think, last year that said around 1 in 5 people that had this assessment were turned down. They were told that they didn't meet the council's eligibility criteria. So as I say, bear that in mind. It's not a given. If somebody has very low needs and the council don't think they're poorly enough to warrant that move into care, the conversation might stop. After the care needs have been assessed, and if you like, a care plan drawn up of what type of care that person needs and where that should take place, whether that's a residential home or a nursing home, then the money conversation should take place, and it should be in that order. It shouldn't be the opening conversation is about money. The opening conversation is about assessing needs. When the needs have been assessed, then the means test is done. I think that's the more commonly recognised term. And what's the means test looking at? Well, breaking it down to a very basic level, it's looking to see whether you have above or below a certain amount of money, and I'm sure you all know this figure. So it's to ascertain in England and Northern Ireland whether you have above or below £23,250. People talk about free care in Scotland. It's not free, it's just a slightly more generous capital limit, about 5,000 more generous, and some other different allowances. It's most generous actually currently in Wales, where the entry point for state support is having 50,000 of capital or less. And these are individual limits, so double them for a couple. Now, before we talk about the care cap, there is another change that is due to be happening next year. And in my opinion, this has got less coverage, less people seem to know about it, yet it is likely to affect more people than the cap, in my opinion. So this change, October of next year, the capital limit in England and Northern Ireland is practically quadrupling. So it's going all the way up to £100,000. And that's, as I say, per person in a couple. So in a couple needing to move into care, assets of 200,000 or less, you would then be eligible to talk to the local authority about being funded by them. Okay. So that's a huge number of people, and that's a huge number of people who might be self-funding now, but once we get to October next year, the money in their bank account is around 100,000 or less. That's suddenly a switch of funding stream. Now, there is a but that comes with this. Lots of people don't fully understand how state funding works. And firstly, it is that you still have to contribute your income towards what the council pays for you. So some people think they can add their pension on top of what the state pays. No, the state expects you to contribute your pension towards what they pay. That's now how it works. That will continue to be the case. And they expect you to still pay something from your remaining savings. It's called tariff income. And this, I won't give you the detailed, the minutiae of it, but currently it works out about £34 a week at the most that you would have to pay from your savings in tariff income. But under the new system, where the lower capital limit isn't changing by much and the upper limit's going all the way to 100, when you do that tariff income calculation, it's going to be over £300 a week that you will still have to pay from your savings towards what the state pays for you. So let's just imagine that the state was going to pay £500 a week for your care, but you've got to pay £300 in tariff income and you've got a £200 pension. You are effectively reimbursing the local authority for what they're paying. It's not costing them anything and you're still paying £500. Obviously, as your savings go down, the tariff income goes down. So there will come a point where you will start to get some financial benefit from this arrangement soon. And it's certainly much, much better than the current system where you don't get any help until you're at 23,250. So it's an improvement, but it does have those caveats that sit behind it. It is not as fabulous as it might look, but there's certainly going to be conversations happening with care homes about moving across to a local authority funded contract much, much sooner in the process than currently. So that's a really, really big notable change, number one. And let's look at what counts as capital. This isn't changing. This is how it is now. This is how it will be next October, that pretty much everything that you have counts as capital. But let me just give you the three main exceptions that I think are worth noting. If it's a couple, then it's only the person moving into care whose capital can be included in the means test. So if you have a joint bank account, only half of that can be included in the means test. 100% of the capital owned by the partner staying at home, that couldn't be included, for example. So there does come a point when you own savings together that you maybe don't mess with the percentages, but separate out and hold in individual accounts. Okay, that's quite important. The property, I think this is something everyone knows, and I talk to people and they don't all know this. A property cannot be included in the means test if a spouse lives there or a relative over 60 lives there, a couple of other exceptions as well. That must be a relative over 60 who genuinely lives there, who hasn't just moved in the week before mum moved out into care. But this is a proper exemption. This is not that the local authority will come back later and try and get the money. The whole time that the house is occupied by the spouse or the relative over 60, it can't be included in the means test. If the spouse living at home predeceases the spouse in care, then from that date, it forms part of the means test. Or if the spouse at home also moves into care, from that date, the house forms part of both their means tests. But we talk to people who are worried that, you know, when my husband in care dies, they'll come back and try and take the money from the house. They can never do that. There's no retrospective claim that would be made. Okay, so that's really important. Obviously, there's complex situations sometimes with properties where half of it's owned by a trust in a will and all those sorts of variables. You can ask us about that, you know, privately if that's you, if you're concerned about a bespoke arrangement. And the third exception I wanted to mention was just for some people, they hold investment bonds that include life insurance. Those are disregarded assets as well. If you're not sure when you're acting as an attorney, you've got bundles of papers and you don't quite know what your loved one has, we can easily identify whether a bond is one of these types or a bank deposit bond, which wouldn't be excluded. So they're the main ones, but pretty much everything else, holiday homes, second properties, business assets, money under the bed, premium bonds, stocks and shares, ISAs, all of that is included in the means test. And there's a catch-all that the local authority have where they can call something out as being deliberate deprivation if, for example, money has been given away over the years, a house put into trust. If they think it's been done to avoid care costs, they can call that, challenge it and say, we're going to treat you as if you still own it because that's what we think happened. So they're getting much stricter about that, investigating things more thoroughly. So that's capital, and people do focus on capital as kind of like the entry point to the system for means tested funding. But as I alluded to earlier, you mustn't forget about income. If somebody has a high income, then they're going to be having to use that to reimburse the council. They may end up not really getting very much at all. If we're looking at a couple and somebody has a private pension, they can pay up to 50% of that to the spouse at home. But all of their state pension, the other half of their private pension, all of that has to be put towards what the council pay for them. There's a little bit, about £25 a week, they can keep for personal expenses. And of course, local authorities do have a limit on what they'll pay. So if you enter the system from day one, being funded by the local authority, they will have a budgetary restriction. You won't be able to just go to whichever home you like, but they have to offer a place in a care home that meets the needs of that person and that they, the local authority, pay for in full. Of course, behind the scenes, they will tell you what you have to give them back, the contribution that you have to make from your pension. But there must always be a sensible option that doesn't require any third party to pay a top up. The only time that third parties should be asked to pay top ups is if that local authority care home place that's offered, the family doesn't like it, the individual doesn't like it, they want mum or dad to be somewhere else nearer to them or with better facilities. The local authority contribution can be moved to the different home, but the amount will stay the same. And if that home is more expensive, that's when a third party top up can be requested from a family member. Usually some charities will pay top ups, etc. So that's one situation where it can be requested legitimately by the care home. And the other situation is if you start off as a self-funder, paying your own way, but you then run out of money. A third party top up could be sought from the family there. This would depend on when this happens. Is it soon after the person moved into care or several years later? It would depend what the care home contract says. It would depend what the discussion was when the person moved in. It would depend whether the local authority and the care home couldn't just kind of meet in the middle and come to an arrangement. But if there's a shortfall and the care home requires a top up, that is a legitimate request on their part. They're the only two situations really that a third party top up can be requested. Now, I mentioned the change number 1 next year. with this much more generous entry point for state funding. Under the current rules, top-ups have to be paid by other people. But from next October, top-ups can be made by the person themselves. And that kind of would make sense, wouldn't it? Because if you have £100,000 of your own money in the bank and you want to stay at a particular home that requires a top-up, and you haven't got a family member that wants to pay it or can pay it, you should have the choice and be allowed to use your remaining £100,000 to be your own top-up. And as I say, under the current rules, that couldn't happen. But from next October, you can be your own top-up using your last remaining 100,000 or less. So that's a positive change, if you like, from a choice perspective, I would say. So that's the sort of whistle-stop overview of the current system that we have for social care, for the means-tested care. I think most of you would be broadly familiar with it, and you can see hopefully now where the changes are, the higher entry point and the being able to be your own top-up. So this system is going nowhere, just those changes will apply. The bit that everybody's talking about, the new care cap system, that is going to be in addition to our means tested system. So this doesn't replace it. You as an individual would still need to look at what money you've got. Are you eligible for state support? Are you not? When does it run down to 100,000? Then you approach social services and ask for their help. So it's your responsibility as an attorney or the individual themselves to keep a tab on what you're spending. And when it drops down to the 100,000, you go and have a chat with social services. The care cap system is actually the local authority's responsibility to keep an eye on what somebody's spending, but we'll go into the detail of that in a minute. And when it hits a certain amount, when it reaches the cap, then some funding should be provided. But that arrangement is completely between the individual and the state. It has nothing to do with the care home. Okay, so the care cap, no interest, no relevance to the care homes. It's completely between the individual and the state. The care homes only get involved with social services if somebody has become funded under the means tested system that I've just outlined. So these two systems are going to run in parallel. It's going to get really, really super confusing because there will be people who are never going to need to talk to social services about means tested support because maybe they sold their house for £500,000. They're never going to run out. They're never going to drop to the 100,000. They're only really interested in opening up a care cap account and what does that look like for them. There'll be other people who come next October will have less than £100,000 at that point, and they'll be straight away having a chat with social services about means tested funding. They're not really too bothered about the care cap because they're being funded. Then there's a whole group of people, perhaps the majority, who will start off interested in a care cap account, not eligible for state support, but before they reach the care cap, their money drops to 100,000 and they go and have a chat with social services. So there's going to be this kind of crossover. So it is going to get super confusing. Now, the first thing to tell you about the care cap is that it will not be retrospective. Anything that anyone spends on their care home fees between now and next October doesn't affect this system. That will be money spent. The clock starts ticking from October 23 onwards only. So that's really important. If you're in care now, your loved one is in care now, you're still eligible to open up a care cap account, but like anybody else coming into the system, it won't start clocking up until October onwards. So no retrospective, no refunds, no nothing. Okay. And as I say, this is completely separate and in addition to the means tested system. So I hear people sort of talking about one figure, and actually there's two important figures. There's 100,000 that we've just talked about, and then there's also this 86,000 that will be the care cap amount. So both systems running in parallel. So hopefully you're clear on how the means tested bit works. how the care cap system works, and I'm predominantly going to look at this as if somebody is self-funding, because it's actually for them that this is going to come as the biggest shock possibly. When they say we're setting a cap of £86,000, there's a lot more to it. That might not surprise you. Firstly, it's only personal care costs that will count. So what that means is there's an element that's deemed to be hotel costs that won't count. But the issue around the personal care costs is that it will be at a rate set by the local authority and not necessarily what you are actually spending on your care. So let me put this as an example and say I go to the local authority as my mum's attorney. She's a self-funder, so we're not having any conversations about means-tested funding. She's got 300,000 in the bank, so she's not eligible for state support currently, but she will be eligible to open up a care cap account as long as she meets the council's eligibility criteria. That point I made right at the beginning that said 1 in 5 won't. So if the local authority thinks she shouldn't really be in a care home, she's not poorly enough, she won't be eligible to open up an account anyway. But let's say they say, no, she is eligible to open up an account. They then say how much they would pay for her care if they were funding it. Now, they're not funding it. She's a self-funder. So this is a hypothetical. They say, yes, but if we were paying for her, this is how much we would pay. So that's the rate that's going to count towards her care cap account. And if that isn't as much as what she's actually paying, then the top-up costs won't count. I'm going to give you a worked example in a minute that I think will bring that home. And as I say, it's personal care costs that count. Your daily living costs don't count, because I think they're arguing if you were in your own home, you would still have to pay your food and your electric and so on anyway. So why should that count towards your care costs? But rather than individual care homes having to sort of separate and itemise anything within their bills, the government has just said daily living costs will be set at 200 a week wherever you are in the land. So that's the bit that won't count. So now let me just give you a worked example, and this could be the bit of the webinar that you do end up playing back a few times. Let's say in my mum's example, because she's a self-funder and she wants to go to the home that's got the good staff ratios, it's got a nice garden area, that's maybe got a cinema and a hairdresser's, maybe she's just heard really good things about their carers and their reputation. She's made the choice, it's 1,300 a week, because that's just what the homes cost in our area. But also in our area, if the council were paying, they would only pay 600. There's a difference, arguably, between the type of care that one might get for that, but not always. But that's how it is. So they say when we open up the care cap account, yep, your mum might be paying 1,300, we'd only pay 600. So it's only 600 that's going to count towards her cap, and we're going to take 200 off that because that's deemed to be the hotel cost or the daily living costs. So on her care cap account that sits there on a computer, looked after by the council, only 400 a week is metering up. That's all that's clocking up on the computer, even though she can show bills, invoices that she's paying of 1,300. So that's not quite how most people are expecting it to work. I think most people think if the fees are 1,000 a week, it'll take 86 weeks to reach the cap. That's what most people will think. But actually, because of how I've described to you it's going to work, it's actually going to take 215 weeks for my mum to reach the cap, because only 400 of what she's paying is metering up. So that's just over 4 years. And that's 4 years from October 23, not 4 years from now. The only variable in this, because obviously this hasn't happened yet, okay, there could be a U-turn. I think because they U-turned it back in 2015 to U-turn again, I'm not sure even this government could do that. The issue is we aren't there yet. So the one bit of the equation that we don't know is exactly what would be the amount the council say they'd pay for my mum. I'm using the figure of 600 because that is the average in the UK for a council contribution, and I can't see why they would suddenly be more generous. If they are more generous and they say that it's 800 a week that they would pay towards her care, and then we take the hotel costs off, then of course the clock, her account on the computer is ticking up at 600 a week. So she's going to hit it sooner, but it's still going to be maybe 3 years before she hits the cap. So we really have to be eyes open on this one, because if we think we just have to pay 86 as a self-funder, then it is going to be a shock. And that's why I said most people, before they reach the cap, their capital might have reduced to 100,000, and they'll be talking to the council for a different reason about moving on to a local authority contract under the means tested system. There will be some people, the minority, who are still in care, self-funding 4 years from October 23, let's say, using that example of the person with the £500,000 house. Over that period, they'll have actually spent 280,000, some from income, but most of it from their savings, but they still have above the 100,000. So they're still a self-funder. There will be some people in that category, not many. What happens to them? Do they suddenly stop paying for their care? No, they're not eligible for means tested support because they still have over 100,000. So all that happens is they still have to pay the 200 a week hotel costs. They still have to pay any deficit between the 600 and the 1300, so those top-up costs. But what they will get is a direct payment of whatever was clocking up on their account. So in this example, 400 a week was clocking up. They hit the cap, they get given 400 a week. So again, the care home's not going to know about any of this. This is between the individual and the state. So 400 a week, to be given that tax-free to go towards your care, great. But you've already spent, as I say, in this example, 280,000 before we get there. And we've still got to carry on paying the vast majority of that 1,300 a week until we run out or hit that 100k floor. So don't shoot the messenger. This is why this is the best format to deliver this information, because you can't physically throw anything at me from your, well, you can, but it'll hit your computer screens, not mine. I don't agree with this system. It's not what I would have lobbied for. It's better than we have now, but it's certainly not how it's been portrayed as all your spend is 86,000. Aren't we fabulous? It's not that at all. Please do watch this bit back, because I appreciate I'll have bamboozled you there with figures. The key is to separate out means tested funding from care cap funding. Means tested, you're supposed to keep an eye on the money, ask for state support when you run out. This, the government, the local authorities are keeping tabs on your account. You should get a statement regularly, but anything that you receive as a self-funder is between you and the government. The care home won't know anything about this. NHS funding. Now, this is a second funding stream, and this exists now, and this isn't changing. This should really be a whole webinar event in itself, and I'm not the specialist to do that. All I can do at this stage for the purposes of today is to flag up that there is another funding stream, but this is where people's needs are predominantly healthcare needs rather than social care. Okay, social care being help with washing, dressing, food preparation, getting in and out of bed. Healthcare is what we would typically go to hospital for. So a nurse might need to be involved in the care package. There might be medication administered, intravenously, etc., catheter, so on. If your healthcare needs are particularly complex, unstable, unpredictable, they're the sorts of words that are used, there's an argument the NHS should pay for all of your care under continuing healthcare. It's quite difficult to get. You might need some support. You might take some advice about chances of getting a claim. People should be assessed for this when they leave, prior to leaving hospital, really. And there's a level beneath continuing healthcare where the NHS just pay for a little bit of your care. If your needs are completely met in a residential setting, social care, then there's no point asking or trying to get NHS funding. You have to have a healthcare need, and it has to be quite, as I say, complex in order to get the full funding. But the care homes will know, they're providing the care. They know whether you are qualifying or should qualify for some sort of nursing care support. This is not means tested, so it doesn't matter what's going on the money side of things. This is just about your healthcare needs. And it might be something that you don't qualify for at the start of a journey, but might come into play later on. Okay, so it's worth knowing about it, and as needs change, then thinking, actually, we wouldn't have been eligible for this at the beginning, but is mum or dad eligible now? And really then, logically, the third funding stream is everybody else. So if you're not eligible for the means tested support because you have too much money, you're not eligible for the NHS support because you're not poorly enough. That's what puts you into the self-funding category, private fee payer. And really the only good news there for you is that you can still claim or continue to receive attendance allowance, non-means tested, tax-free, state benefit for people paying for their own care, and it absolutely carries on if you are in a care home. If you're not aware of this, contact me. I can give you the phone number to make a claim. We've even got a 25-minute YouTube video how to fill in the form. I didn't record it, but I know somebody that did. So that is worth knowing about. And the only other real benefit for self-funders, I'm afraid, is a limited category, and that's somebody who has a property, but a property that's not occupied by a spouse, not occupied by a relative over 60, for example, and would be left vacant when the person moves into care. If that's their main asset and the other funds are less than the capital limits that we talked about, then the local authority, if they agree that the person needs to go into care, so the care needs assessment, they have to be eligible. If that is agreed, the local authority has to ignore the value of the property for 12 weeks. So if your other money's under the limit, that means they pay for you for 12 weeks, subject to the way I've outlined earlier. State funded limits, you still have to contribute your income. But what you get paid for you during that 12 weeks does not have to be paid back. And the idea was just to give people time to think, or give the attorneys time to think about what to do with the property. So we said earlier, does it have to be sold to pay for care? Well, it's sort of a play on words, because at some point, yes, probably, but it doesn't necessarily have to be sold during mum or dad or auntie or uncle's lifetime. Now, you could, as a family, decide to rent the property out. That does work in certain situations, not all. You've got to think about income tax on the rent. You've got to think about money that needs to be spent on the property to get it to a rentable standard. But equally, it might be in a highly sought after area where you could command a good income. However, most families, when we talk this through as a possible solution, say, well, look, the rent after tax plus the pension plus the attendance allowance, still not enough to pay the fees, we'll have to sell. And then they might say, but we could get some equity release, and talk to a mortgage company. You can't get equity release on a vacant property where someone's moved out and moved into care. Your equity release can only really be arranged when the owner is there and you're living there. And usually they all come with a clause that says, when you move out into care, you have to pay us back. So your traditional equity release wouldn't be a solution. But what you could do is talk to the local authority, because they have a kind of equity release scheme. It's called a deferred payment. And this simply means that you wouldn't have to sell during your loved one's lifetime. You borrow any money that you need to pay the fees from the council. So all local authorities have to have a scheme in place for their citizens. They can still turn down individual loans, okay? So they can still say, you've got a mortgage on that property, we can't lend on it, or you haven't got enough equity, it's a low value property, we're not going to lend on it, or it's on a floodplain and we don't want to risk it. But as a local authority, they have to have a scheme in place and give you the details. You'd have to pay a setting up fee and interest, but the interest is pretty low, and you're only paying interest on the amount you borrow, not the value of the property. So if you're only borrowing £500 a week, that's what you're paying the interest on, but it rolls up. You don't physically have to make the payments. You still have to meet the council's eligibility criteria, of course, and you have to have assets under the capital limit. But here, the local authority can lend you full fees or however much you need. They don't restrict it, they'll have to restrict it to the local authority rate. So it really could be a good solution if you think it's a rentable property. follows on from the 12-week disregard. You should be offered those 12 weeks of free funding first, and then you roll over onto the loan from week 13 onwards. It's not for everybody, but you just need to know it's there. If you do decide to sell, we do have a service, a sort of outsourced estate agent, property manager, where they can deal between, rather than you having to go direct to estate agents, they can organise all the valuations and act for you. You pay them instead of the estate agent, and then they can also assist with all the meter readings, liaising with solicitors, and all the time consuming elements of selling a property for a loved one in care. So again, we can put you in touch with that service. So just flagging it up so you're aware of it. Get individual advice from us if you think it affects you. So really, just in closing, just to put this out here, as I think when you present problems or areas of concern, it's good to put forward a solution. And we certainly have concerns shared with us, every day. Our helpline rings with families, sharing concerns about cash flow forecasting. How am I supposed to know, without a crystal ball and without knowing how long mum or dad is going to be in care? How do we know what we can afford? Should we be choosing that one or that one? Or how long can mum stay there? We don't have the crystal ball. We don't know how long the money will last. And the second concern, following on from that, what happens if that money does run out? So they're the concerns that are often shared with us. They may be concerns that you have as a family. And our job, having sort of gone through a triage of all that we've covered earlier to make sure somebody's getting the right funding and that they have been correctly assessed, if we're now talking to a self-funder who's sharing those concerns, we will put forward a solution that 85% of them will never have heard of. So statistically, the majority of you on this webinar today probably won't have heard of it either. It's not a solution for every self-funder. If we speak to a family where there's enough money to self-fund for 1 year, 2 years, 2.5 years, this solution probably won't work. There's not going to be a way, that a legal, legitimate way, that will stop that money running out if they are in care for the year to 2 years. However, if somebody has enough money, typically for longer than 3 years worth of self-funding, and we must factor in income. We don't just look at what you've got in capital. Remember that you've got the pension and the attendance allowance as well. So the money will go a little bit further perhaps than you first thought. If someone has roughly 3 years or more of self-funding, the solution that I'm going to just outline for you now, as I say, most of them won't have heard of it, but for the vast majority, it could take away those worries. So because this is all we do day in, day out, when we have that first chat with families or an email exchange, we know whether this is likely to work or not. So if it won't, we're straight with people. If it might, we'll say, it might not. And if it certainly would be viable, great, we can do that research for a family. We can certainly give an indication of likely affordability. So what am I talking about? Good question. I'm talking about a way of capping costs yourself. This does not opt you out of the care cap system that the government's bringing in. Anything that you qualify under the care cap system, you'll still get that, but you might not want to rely on it. We've seen how little it could be. We've seen that it might not kick in until 2027 at best. So some families will still want to make provision for themselves to protect their money, okay? And what they can do is insure care home fees. Now, with most types of insurance that you'll be familiar with, you have to do it in advance. Yeah, you can't insure your holiday when you get home from it. You can't insure your car after the accident, but you can insure care home fees at the point of moving in, or even after you've moved in to a care home. Some people have to sell their property before they have the money to be able to afford to buy insurance, and that might be 4, 5, 6 months after they've moved into care. That's fine. What you can't do is actually insure care home fees ahead of time. There's no pre-funded insurances on the market to buy anymore. The technical term isn't insurance. The Google search engine term is care fees annuity, but there's a bit of stigma around the word annuity, and if you talk to your sort of average, even people in financial services, if you mention an annuity, everybody turns their nose up and says they're expensive and they're poor value. That might be the case, I don't dispute that, but I suggest they're confusing it with a pension annuity, a retirement annuity. And they were deemed poor value because people, at the end of the day, you save into your retirement fund, it looks quite a big amount of money, and then you retire and you get a small pension. But that's because the insurance companies are expecting to maybe have to fund you from the age of 60 to 90, 95. So that's 30 years they're going to be paying out. They have to attach a widow's pension. They have to build in escalation. Lots of big asks from this pot of money. So the income that you get shrinks down. Yes, poor value. But a care fees annuity, which is the same concept, you swap a lump sum payment, give it to an insurance company, and they pay, usually the care home, a tax-free income for life. So the concept is the same. But here, the average purchaser is not a 60-year-old. The average age of our client is 89. We've had our oldest client was 103, our youngest client 67. So a big range, but typically 89 would be the age. So the insurance companies are not anticipating paying out for 30 years. And of course, this person has some health issues. That's why they're in the care home. They need some support. So that's going to have an impact as well on how long the insurers think they'll be paying out. So you get a much bigger income from your pot of money, or you need a much smaller pot of money to get the income than you would do with a pension. So it's a really lazy mixing up, really. It's lazy language in the financial services industry, and it can send people off down the wrong track. It's a different product, and what makes it different is that it's individually underwritten rather than just a standard rate table. So every care annuity will be bespoke for the person, taking into account their age, what their family has said about their health, what the doctor says about their health, and what the care home says about their day-to-day care needs. The individual, by the way, doesn't even need to know this is going on. This is all stuff in the background, no examinations. So when someone says, what will one of these plans cost? Well, they're all different depending on somebody's health, and also depending on how much income they need from it. Because whilst two people's care home fees might be the same, one's pension might be higher than the other, one might have some rental income. So what they need from the annuity will vary, and therefore the cost of the annuity will be different. So our job, if you like, as a sort of meerkat, as a broker, as a go-between, our job is to get the information from the family, work out what's needed, then go to the insurance companies and get the quotes. I said to you earlier, we will do that free of charge, because unless you know what it's going to cost, how do you know if you want one? The notion that you should have to pay to find out that something is too expensive for you just doesn't sit right with us. And we want to be able to tell you whether it's appropriate or it's not, and you walk away no cost. We then write a report for you if it does all look viable and it's affordable based on what you've told us. We write an advice report, and that answers all the sorts of questions that you might be starting to think now, like, if I bought one of these, can I take it from one care home to another? Yes, the report would tell you it's fully portable. The report will tell you what it would cost to build in escalation, because care fees will go up. Do you want your annuity income to go up, or would you rather have a flat income and pay the fee increases from the money that's left? There's lots of little nuances and decisions to be made, and this is all we do, so we'll be able to guide you as to whether we think you should or you shouldn't have these add-ons. Now, at the end of the day, these policies are a gamble. You're gambling, taking a bet on somebody's life expectancy. And it's going to be tricky because it's emotional as well. So we have to just come at it from a purely factual perspective, and having no annuity and funding the care from savings, that's a risk as well, because it could run out. We don't know that the state will definitely pay. We don't know how much the state will pay, whether you'd be able to stay at that home, lots of unknowns. So there is some risk in pay as you go. Yes, you can invest money, but that's still pay as you go. If you get positive returns on your investment, and there are lots of negative returns at the moment, if you get positive returns, it's still, the money could run out. It just might last a little bit longer. So annuity, different way of funding. It's one or the other, really, pay as you go or insure. And the insurance comes with a risk that you give a lump sum to the insurance company, and then mum or dad dies, a year in, 2 years in, before the insurance company has even paid out what you spent on the policy. So that's a risk. But if mum or dad lives longer than the insurance company predicted, the insurance company still has to pay. So that's, you know, the gamble. But to minimise the gamble, then obviously, if that is what families are worried about, there are things that you can do to protect the capital, and we'll advise you on those options, even buying the policy on a delayed start date basis, and we can talk you through that. That's a good thing. It's the version I would do. These policies are fully protected by the Financial Services Compensation Scheme, no cut-off, no 85,000 ceiling, and people are doing it to either ring fence the money that's left, so there is something for the beneficiaries, or to avoid the scenario of asking for means tested support and the concerns and worries that might bring. As I say, this doesn't negate you from getting money under the care cap. You'd still get that money, the £400 a week. You'd still get that even if you'd bought the annuity, but this does opt you out of the means tested system completely, because you don't need their funding. You've got an income for life. You can pay private fees for life. There might be a scenario where you don't need it anymore, and that would typically be if you qualify for NHS funding, the income from the annuity just goes to the individual, just goes into the bank, but then does suffer a small tax charge. And again, just to reiterate, we don't charge for the research or for the advice report. That's our business model, and there's lots of people who come in thinking they want this and it doesn't turn out to be the right thing. We're not invoicing you for going through that process, but we will be paid a fee if a purchase is made. That will be a higher fee than if we were charging for the research, of course, but we'd be out of business if we don't get this balance right. And that's built into the quotes that we give you, so there won't be any surprises there. These are the 4 insurance companies that offer these policies. There are just 4. We go to all 4 every time. We have great relationships with them. We can, in at least 2 cases, usually haggle a reduction for you off the price and get the best possible deal. The latter 2, Legal and General and National Friendly, actually launched their care annuity products through my company in the last 2 or 3 years, so we did have an exclusive with them. My point is, we know all the nuances of these policies. If there's a deal to be done, we'll get it for you. And that's it, really. That's our closing slide, because that has the contact details I promised you. Eldercare Group is the website address. 0800 082 1155 is our office hours manned free phone number. You do not need to ask for me, any of my team, Tracy, Sarah, Roger, Michael. They're all very, very experienced. And if you prefer just to sort of drop an out of hours summary of your situation or questions, use please the advice at Eldercare Group email address, and that can be responded to out of office hours. The reason I landed on this page was simply there's a care fee annuity tab, and it has a ready reckoner on it. So if you did just want to, I really haven't got a clue what one of these might look like, use the calculator. It's based on quotes we've obtained for other people of the same age in care, but of course there'll be a variance of some will be healthier and others will need more support. So it's a ballpark, but it's a good place to start. There's lots of other information there on the website as well, and as I say, we'll get the recording of this event over to you hopefully today, so you can recap